Senior VP and Fund Manager Equity at UTI AMC, joining in on the show right now. Karthik, hi, morning. Good to have you on ET now. And Karthik, other than IndusInd Bank, the quarterly updates from the private banking names seem to be quite handsome. Do you think it's only going to get better as we move on the quarters?
Yeah. Hi, Aisha. Good morning. So banking clearly, the private banks is far more structural story. I mean, they can continue to grow at a pace higher than the industry and the GDP over a longer period of time. In the near term, obviously, we've seen overall the banking credit dip into single digit and just about double digit currently. So as of now, the credit growth is slightly lower, but with the slew of rate cuts, direct tax, indirect tax cut, and the liquidity infusion, we should see the growth acceleration in the next few quarters. And probably, anyways, for the banks, the second half is the busier season. So in the second half, we should start to see some improvement in the growth. But we would look at the longer term growth prospects, and that for private banks clearly looks good.
What would you pick, Karthik? Hi, this is Harsh. Good morning. Between private and PSU, what would you pick? Because the valuations seem more reasonable on the PSU and on the small, medium-sized banks, and the growth likely seems to show some bit of zing as well now. Maybe some bit of asset quality was waning away likely. Are those pockets looking better? And is PSU, just to extend that question, is the ROA and profitability metrics looking far more sustainable given the kind of growth numbers they've posted?
Yeah, so from a structural perspective, clearly the private banks can continue to grow much faster than the industry, while the public sector banks, select few public sector banks may be in line, and few of them could be even lower. But at this point in time, as you rightly highlighted, even the public sector banks don't have any asset quality issues, and the return ratios are quite comforting. While the ROAs may be a little lower compared to the private banks, but due to the higher leverage, they tend to have almost similar or even in some cases better ROEs. Near term, there is no much of asset quality issues and the growth are similar. So from a valuation perspective, select PSU banks look quite good, but from a structural long-term perspective, would still believe that private banks could continue to grow faster and higher for longer.
Karthik, do you think the big bump up from the GST rationalization is going to trickle through to the autos as the markets much have, shown that kind of reaction as well? Or do you think it's going to be distributed within the other consumption pieces, which is, FMCG, white goods, BPC, etc.?
Yeah, so the GST cut is definitely a positive for the consumption space as a whole. But typically, while the cuts may be even for FMCG and durables discretionary, the one would believe that the lot of savings would eventually move to some of the discretionary items. It could be durables, it could be autos. As of now, clearly the price cuts are far more sharper in auto, and that's where the expectations have been built high, and the stock prices probably have reflected some of that or even done a little more than that. But would expect overall discretionary space as such to benefit from this in the next few quarters.
Karthik, from again a metals perspective, we're touching all-time highs where metals are concerned. It's not a story which is being given enough traction, if I can call it. And credit to the sector as well. The sector itself is up maybe 25% from in the current year itself, in the current calendar year. So one of those which has seen a sharp re-rating. What next for it, in your opinion?
Yeah, so metals over last few years post-COVID, the balance sheets of most of these companies have improved dramatically, and to that extent, their debts are much more at manageable levels, and to that extent bring in a lot lesser volatility. From business perspective, the ferrous metals continue to have good volume growth domestically, and that is positive. And overall, probably the valuations are still not too expensive, considering that the balance sheets are far stronger today than in the previous cycles. So to that extent, one would be positive on the sector from a near-term perspective.
Sure. Karthik, this week we're also going to be stepping in officially into the earnings season as well, starting off with TCS. What's the anticipation on whether or not IT can finally resurrect itself in terms of earnings performance?
Yeah, IT clearly in the near term seems to be going through a rough patch in the last couple of years. The growth has slowed down. Probably that continues as of now. But the valuations have come down to very attractive levels and probably pre-COVID levels. And these are companies with very good cash flows, good dividend yields, good corporate governance. The longer term growth trajectory still looks reasonable in dollar terms, plus they benefit from the rupee depreciation. So all this put together, we would believe that the current valuations are building in most of the negatives of near-term growth slowdown, and to that extent, positive on IT sector from here on.
Interesting. And is there a preference, large, medium, small? How do you view it? Because the growth rates are markedly different, and so are valuations. Karthik?
Yeah, so seems clearly mid-sized IT companies could have longer runway for growth, and deservedly they are trading at a premium multiple. So on a valuation basis, clearly the large caps fare little more attractive, but the mid-cap companies have a good growth prospect, and if at all should there be much correction there, that's a good space to kind of look at adding.
Karthik, a lot of liquidity is getting sucked into the primary markets as well, right? I mean, this week alone, you've got Tata Capital opening today, LG opens tomorrow. Do you think with this IPO flow, the moves on the secondary market are going to continue to be lukewarm and much more range-bound than what we've already seen?
I think in the short term, very difficult. There are 2-3 moving parts. I mean, you have the FI, domestic flows, and the primary issuances, like you mentioned. But eventually, I mean, the markets would be focused more on earnings, and that's where FY27 earnings growth should be in double digits. FY26 maybe still slightly muted, but FY27 we should see acceleration in earnings growth as inflation also comes back, nominal GDP gets into double digit. And to that extent, the outlook for earnings growth in next few quarters starts to improve. That's where we would be positive on equities from a longer term perspective. The primary issuances, I mean, if there are a lot of flows, there is liquidity. Obviously, you'll see a huge pipeline of IPOs and primary issues, but eventually what matters is the earnings growth, and that we believe should start to improve in next few quarters.
Karthik, taking a step back and trying to assess the macro picture as well. You know, one is you'll have some pressure on the fisc, given all of the measures that the government has taken. The other piece is the fact that there is a strong push to enable a capex cycle to come through. How best do you play both of these? Because the lower or the slight amount of pressure on the fisc could well mean that government spend could come down on the capex spend side, and you also have a private capex cycle which could kick through. How best do you play this?
Yeah, hi. So on the overall fisc perspective, we're not seeing too much of a pressure even now. I mean, even with both the direct and indirect taxes cut, the second half borrowings also are largely in line, and to that extent, don't expect too much of a fiscal pressure. The consumption boost is what is expected to kind of deliver higher tax returns. The volume should kind of take care of whatever is the indirect tax cuts. Eventually, we would hope that the private sector capex starts to pick up. The government has done its bit, and the government capex has grown well. Even in this year, in the first few months, the capex growth is good. The private sector capex could do much better. I mean, whatever measures need to be done in terms of incentives or any other SOPs that need to be given could be the focus area for reviving the private sector capex eventually, even from a medium to long term perspective. So we believe the fiscal is largely okay, and the near term, the consumption side should get some benefit. And come February, we'll have the budget, and hopefully the capex focus still continues.
Right, okay. Karthik, great to have you on the show. Thank you so much for taking the time out and speaking with us today.